Imagine spending tens of thousands of dollars to fix a serious problem with your home, doing everything right, using better materials than required, protecting your property from almost certain water damage, and then getting punished for it. Not by a contractor, not by a neighbor, by your own insurance company. That is exactly what happened to one homeowner who replaced a failing roof out of pocket, asked their agent to update their policy, and watched their premiums go up. Not down, up. And the explanation they got back made almost no sense at all. Stick around, because by the end of this video, you are going to understand exactly why this happened, whether it was fair, what they could have done differently, and what you need to know before you ever replace a single shingle on your own roof. Let's set the scene here, because context matters a lot with this one. When you buy a house, especially an older home, one of the biggest wildcard expenses you inherit is the roof. A roof is not forever. Depending on the materials, the climate, and the installation quality, a typical asphalt shingle roof lasts somewhere between 15 and 30 years. When it starts to fail, you are not just looking at replacing some shingles. You are looking at the potential for water intrusion, rotting decking, mold, damaged insulation, ruined drywall, and in serious cases, structural issues. A failing roof is not a cosmetic problem. It is a ticking clock. This particular homeowner and their spouse bought a house knowing the roof was in rough shape. And to their credit, they did not ignore it. They did not cross their fingers and hope for the best. They replaced the roof out of pocket using higher quality shingles than what was originally on the home. They were proactive, financially responsible, and genuinely trying to reduce the risk of a major loss. So when they called their insurance agent to update the policy and expected to see some kind of reward for their responsible behavior, what they got instead felt like a slap in the face. Their premium went up, and the explanation from their agent, while technically accurate, left them more confused and more frustrated than before. Let's walk through exactly what happened and why. When the homeowner originally purchased the house with the old deteriorating roof, that roof was already well into its lifespan. Insurance companies know this. In fact, they factor it in aggressively. When a roof is old, insurers typically do not offer what is called replacement cost value coverage on it. Instead, they offer actual cash value coverage. Here is the critical difference. Replacement cost value means that if your roof is destroyed, the insurance company pays you what it costs to replace it with a new roof today. Actual cash value means the insurance company takes that replacement cost and then subtracts depreciation based on the age and condition of the roof. So, if your roof is 15 years old and has a 20-year lifespan, they might decide it has already lost 75% of its value. You get 25% of what a new roof costs. That is it. In this homeowner's case, the agent mentioned the old roof was covered at 40% of replacement cost. That means the insurer had already depreciated that roof down significantly. If a new roof costs $30,000, the insurance company was only on the hook for $12,000 on the old one. And here is the part that really stings. The premium the homeowner was paying reflected that limited liability. The insurance company was not taking on much risk financially, because even if the worst happened, they were only paying out a fraction of the replacement cost. Now the homeowner replaces the roof. Brand new, high-quality materials. The insurance company's liability changes dramatically overnight. Now, instead of being responsible for 40% of replacement cost, they are responsible for 100%. That new roof costs $30,000, and if it gets destroyed by a hailstorm or a falling tree, the insurer now has to cut a check for the full $30,000. From the insurance company's perspective, their exposure just increased by a factor of 2.5. Of course, the premium went up. That is the math working exactly as designed. More liability for the insurer means more cost for the policyholder. Now let's talk about the part of this story that is genuinely frustrating and worth calling out directly. The homeowner makes a really sharp observation. Before replacing the roof, they had close to a 100% chance of eventually needing to file a claim. The roof was failing. Water damage was essentially inevitable. After replacing the roof with premium materials, the likelihood of a claim drops dramatically. So in terms of actual risk, the situation improved enormously. The homeowner's logic is sound. Less chance of a claim should mean lower premiums. But insurance pricing does not work purely on probability of a claim. It works on the dollar amount of exposure combined with probability. A small chance of a huge payout can cost more to insure than a large chance of a small payout. The insurer went from likely paying $12,000 at some point soon to unlikely but possible paying $30,000 at some point in the future. The math on expected loss actually shifted in a way that costs the insurer more, even though the actual physical risk of damage went down. Now here's where this gets complicated in a way that should make every homeowner uncomfortable. The original homeowner raises another question. Why did their agent never suggest filing a claim on the old roof before replacing it? This is a legitimate and important question. If the roof was in genuinely failing condition, there may have been a valid claim to file. Wind damage, hail damage, and wear-related failures from weather events can all potentially be covered depending on the policy terms. Filing that claim before replacing the roof out of pocket might have gotten them $12,000 toward a $30,000 job. That is not nothing. Whether or not that claim was viable depends entirely on the specific policy language, the cause of the damage, and the inspection findings. But the fact that the agent apparently never raised it as a possibility is worth noting. Agents are not always proactive about exploring all your options. Sometimes you have to ask the right questions yourself, and sometimes you need to ask more than one person. There is also the matter of the upgraded shingles. The homeowner specifically mentioned they used higher-rated shingles thinking it might reduce their premium, and that the roofing contractor suggested this would help. It turns out the insurer did not factor the shingle upgrade into the premium at all. This is a common misunderstanding. Some insurers do offer discounts for impact-resistant shingles, particularly those with a Class 4 rating. But not all insurers apply this discount, and not all contractors are accurate when they suggest that upgrades will reduce your insurance costs. If you are replacing a roof specifically hoping to get a premium discount, you need to confirm directly with your insurer before the job is done, not after. So what can you actually take away from this story? A few things that could genuinely change how you handle your home and your insurance policy going forward. First, before you make any major home improvement, call your insurance agent and ask how it will affect your premium. This sounds obvious, but most people do not do it. A new roof, a pool, a finished basement, an addition, all of these can change your coverage liability and therefore your cost. Find out before you spend the money. Second, understand the difference between replacement cost value and actual cash value coverage, especially on your roof. When you buy a home with an older roof, ask your agent specifically how the roof is being covered. If it is actual cash value, you know going in that your payout in a claim will be limited. Some insurers will not even offer RCV on a roof over a certain age, so you may be locked into ACV until you replace it. Third, if you have a roof that is at or near the end of its life and you are planning to replace it anyway, have a professional inspection done first and review your policy carefully. There may be a path to a partial claim that helps offset your costs. Talk to a public adjuster or a second agent if your current agent is not walking you through your options. You are paying for that policy. Make sure you understand what it actually covers. Fourth, if you do install upgraded shingles, specifically ask your insurer whether those materials qualify for any discount on your premium. Ask for the specific rating requirements in writing. Do not rely on what a contractor tells you about insurance implications. Contractors are experts in roofing. They are not experts in insurance. Fifth, and maybe most importantly, do not assume that doing the right thing for your home will automatically translate into a lower insurance bill. Insurance pricing is not a reward system. It is a liability calculation. Understanding that distinction will save you from a lot of confusion and frustration. This homeowner did everything right from a property maintenance standpoint. Their home is now in significantly better shape than it was. And yes, their premium went up, but they also went from limited partial coverage on a dying roof to full replacement cost coverage on a brand new one. That is a real benefit, even if it does not feel like it in the moment. The lesson is not that they made a mistake. The lesson is that understanding how insurance values your home before you make changes puts you in a much better position to make informed decisions. If this has ever happened to you, or if you are about to replace your roof and you are not sure how it's going to affect your coverage, drop your question in the comments below. We read everything, and we put a lot of these stories directly into future videos. And if you found this useful, subscribing takes 2 seconds, and it means we can keep making content that actually explains the stuff your agent probably never told you.